Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hi guys, this is Justin. In this episode of Excess Returns, Jack and I walk through Warren Buffett's letter to shareholders from Berkshire Hathaway's most recent annual report. Buffett's letters are always full of knowledge and long-term investing wisdom, optimism, and historical and important perspective. From never betting against America to share buybacks and the importance of retained earnings, to the 4 Berkshire jewels that drive most of the firm's value over time, Jack and I work through the details of the letter in an effort to help investors learn and grow from Buffett's knowledge. Thank you for listening. We hope you enjoy this discussion around Warren Buffett's annual letter. Today, what we're going to do and what we decided to do is we wanted to sort of work through Warren Buffett's annual letter to shareholders, which was released last Saturday. There's obviously been a lot of media highlights about the letter, but we thought we could kind of maybe work through this for our listeners. For those that maybe haven't read those articles or maybe didn't read the letter, I think we encourage you to read the letter because there's a lot of obviously wisdom and I think nuggets of just really good information in there. People can get the annual letter on Berkshire Hathaway's website. You just go there and then I think you just look for annual letters and you'll find it. And Buffett's part is the beginning of the letter. It's basically the first 15 pages. So maybe I'll just start. His letters always start out with the performance of Berkshire Hathaway versus the S&P 500. So he used to report out the book value of Berkshire, but he moved it to actually the performance in terms of the market value of the shares. And he lists the returns going all the way back to 1965, which is when Berkshire Hathaway was first founded. Interestingly enough, not based on what I can tell, he actually doesn't talk about performance in the letter itself. 2020 wasn't a great year for Berkshire Hathaway, but I don't think Buffett really cares about what happens in one year, but there wasn't too much mention of the actual stock performance in the letter itself. So just to start, he starts by talking about, and I think this is an important concept just for investors to understand. He starts by talking about the GAAP reported earnings of Berkshire Hathaway and the operating earnings. So just real quick, on a GAAP reported basis, the company earned $42.5 billion in 2020, but that number includes the unrealized gains of stock that they own. So what Buffett says is it's much cleaner, it's much better to use the operating earnings, which on an operating earnings basis, the company basically generated $22 billion, $21.9 billion in operating earnings. So I think the important thing there is just, when you're thinking about sort of earnings that are reported out, earnings can be pretty noisy. And so sometimes operating earnings, are a much, much cleaner number. The other, and we're going to kind of just walk through the letter. So in terms of the next thing that jumped out at me, and then Jack, I'll let you kind of go, is Buffett, when he's talking about, and we'll get into some of the companies that he owns from a public stock standpoint, but what he points out is that the retained earnings of the businesses and stocks he owns, that never really shows up in sort of the current earnings stream, let's say. I mean, obviously the stocks that he owns, they're being assigned a value in the marketplace, and that value of the company is being determined from their earnings stream. But as Buffett points out, there's the companies that he owns, some of them will go on to generate extremely good returns based on the retained earnings, and some of them won't. But over time, businesses that can retain their earnings and actually generate positive returns on those earnings, that's a very important driver of value in stocks over time. And actually in last year's shareholder letter, he expanded on this concept quite significantly and gave examples of how retained earnings over time can be extremely important in terms of driving the value of a business. Jack, you want to kind of work through the next point?
Yeah, so one of the things that struck me about it was his ability to admit his mistakes. And he was talking about the precision cast parts investment, which I think was an $11 billion write-down. And I'll read from the letter because I thought it was really interesting. When you take a step back and think about it, Buffett is what, 90 some odd years old now. He's probably, in terms of, if you look at the rate of return he's generated and the length of the period he's generated it over, he's probably the greatest investor of all time. And yet he always spends time talking about the things he did wrong. And so there's a lesson for all of us in that, who are unwilling to admit our mistakes in investing, that if the greatest investor of all time spends this much time on his mistakes, we should probably spend some time on ours as well. But I'll read it because I think it was really interesting. The final component in our GAAP figure, that ugly $11 billion write-down, is almost entirely the quantification of a mistake I made in 2016. That year, Berkshire purchased precision cast parts, and I paid too much for the company. No one misled me in any way. I was simply too optimistic about PCC's normalized profit potential. Last year, my miscalculation was laid bare by adverse developments throughout the aerospace industry, PCC's most important source of customers. In purchasing PCC, Berkshire bought a fine company, the best in the business. Mark Donegan, PCC CEO, is a passionate manager who consistently pours the same energy into the business that he did before we purchased it. We were lucky to have him running things. I believe I was right in concluding that PCC would over time earn good returns on the net tangible assets deployed in its operations. I was wrong, however, in judging the average amount of future earnings, and consequently wrong in my calculation of the proper price to pay for the business. PCC is far from my first error of that sort, but it's a big one. So it's really interesting. I mean, you're looking at someone who's been this successful, and he's admitting a bunch of mistakes in that, and also it goes to what's a really important point for everyone to think about, which is great businesses at the wrong price are bad investments. And so if Buffett even gets tripped up by that sometimes, you'd expect, a lot of other investors will get tripped up by the same thing, because no matter how good the business is, and he talks about how this is still a good business and things are still going well inside the business, his criticism of himself is basically, I just paid too much for it. And that's a trap that a lot of people have fallen into over time. So I think it was a really good lesson to learn, first of all, that one of the greatest investors of all time is being this honest about his mistakes, but also that we all have a tendency to overpay for businesses, and that can be a problem even if it's a good business.
Yeah, and that I think relates perfectly to the next point about conglomerates, which is, where he was basically talking about how, and it kind of made me think of like General Electric. He didn't use General Electric at all, but that a lot of times these conglomerates, that are aggregating these businesses and buying businesses outright, they pay way too much for the companies that they're buying, and that ultimately ends up being, bad for the long-term value of those conglomerate type companies.
Yeah, there's two things there. One is obviously when your only criteria is I want to buy a whole company, well, you're going to pay for that control. And so you end up paying a higher price. In order to get that control, you end up paying a higher price, and maybe you end up overpaying for the business. The other thing which you pointed out in the letter, which I thought was really good, is a lot of great companies just don't want to sell the whole company. And so you're really limiting your universe. If you only look at companies that are willing to sell the entire company to you, first of all, you're limiting your universe because some great companies don't want to do that, but also you're limiting in terms of size. So for instance, the Apple investment doesn't work if you're only trying to buy the entire company. Berkshire's obviously not going to buy all of Apple. So, that's a great investment where if his criteria was I'm only buying the entire company, he never would have made it. So I think I think he's right about that. And I think, you want to be flexible, and he's showing that, and that he's not, he does buy some entire companies, but he's also willing to take much smaller stakes if he thinks that's what right for Berkshire.
Yeah, absolutely. So he talked about the four jewels of Berkshire Hathaway. He talked about the insurance business, and the float that has. Basically, there's a $138 billion float on the insurance business that they can use to basically redeploy in investments. There's Burlington Northern Railroad, which is, I think, the largest railroad in the country. Buffett bought that company, I think it was maybe 2010, 2011. I'm not sure the exact year, but that's the second jewel. And then he said the third and fourth jewels are basically a toss-up between the company's 5.4% stake in Apple and Berkshire's energy business. So those are, when you think about the drivers of value for Berkshire and its stock price, those are the things that are going to matter the most. There's a lot of other companies he owns, both in the public markets, and they have a lot of actual businesses that they own. Like you said, they own fully, but those are the big drivers of what drives the value in Berkshire.
Yeah, I mean, it still amazes me what he, and this kind of gets to our next point here, what he was able to do with Apple. if you think about, like, first of all, that's been, I don't know, I forget what his total profit is on Apple right now, but it's a massive amount of profit, and it's something that for much of Buffett's career he never would have invested in. And his ability to pivot has been so impressive, that he went from a deep value guy to sort of a value and quality guy, and now who wouldn't invest in technology, to now a guy that realizes technology's matured, and I need to operate in that space, and that's led to a lot of profits for him. So I think it's great because it shows Buffett's flexibility and Buffett's ability to change his strategy, when it fits in order to benefit shareholders.
Yeah, and by the way, I think that plays right into the next part of the article, which is where he's talking about buybacks. I mean, for a long time, I think Berkshire Hathaway had a I think the stock needed to trade below book value for them to buy back the stock. And Buffett's been very critical of buybacks because he basically says a lot of, companies, when buying back their stock, they're buying it at expensive levels. And so therefore those buybacks aren't good and they don't add value over the long term for the company. But Berkshire actually started buying a pretty significant portion of its stock back last year, spent $25 billion on buying its stock back last year. And then he also talks about how Apple is buying back its own stock. So you get like a enhanced, because Apple's buying back its stock and Berkshire Hathaway owns a very large percentage of Apple and Berkshire's been buying back its stock. It's like you get this magnified effect of increased, profit as a shareholder because the buybacks are reducing the share count. So that was something that he sort of talked about in the article, and I certainly encourage folks to read that.
It's like you've coined a new term here, the double buyback.
Yeah, exactly.
You're basically getting buybacks on both ends of it.
Maybe we could have a new strategy, the double buyback strategy.
Yeah, we could launch an ETF, although I don't think there's too many stocks that could actually be in there.
Right, right.
But yeah, I'm thinking there were a couple things that takeaways for me on the buyback thing. One is, I think some politicians who've been in the news recently may want to read the letter because, this whole idea that, although buybacks can certainly be a bad thing when used in the wrong way, this whole idea that buybacks are just always a bad thing, if that's the case, one of the best investors of all time would not be sitting here buying back his stock. So, there's a tendency to think, and again, buybacks can be used, when buybacks are used where companies are issuing stock options, beyond what they should to their executives and then using buybacks to wash that out. Obviously that's a terrible use of buybacks, but the vehicle of a buyback itself, there's nothing wrong with it. And, it's interesting because if you look at what Berkshire is, their investable universe is actually pretty small. I mean, they can't buy small cap stocks. They're not going to invest in mid cap stocks. And even part of the large cap universe is not available to them. So it's certainly possible that within that universe, where Buffett sees the most value right now is his own company. And so if he sees the most value in his own company in that universe, why wouldn't he buy back his stock? I mean, it would be, he'd be doing a disservice to shareholders if he invested in some other business that he doesn't think is attractive instead of buying back his own stock. So I think it's great that he's been buying back his stock. And Berkshire hasn't done well in recent years, so it's probably a fairly attractive value relative to some of the other things he's looking at.
Yeah, I just wanted to quickly hit on some of the top holdings in his portfolio right now. Basically, he owns, of course, the top one is Apple. And to answer your question, he has a cost basis on Apple of $31 billion. Its market value as of the end of last year was $120 billion. So in terms of the dollar size, he's up $90 billion in that investment since 2016. And like we mentioned, he owns 5.4% of the largest company in the world. $18 billion in American Express, $31 billion in Bank of America, has a $21 billion stake in Coke. And then, after that, it kind of drops off. He has a $13 billion stake in Kraft Heinz, although they don't report that as a publicly traded company. I don't know if Kraft is now private or what, but the point is that, when I look at Buffett's publicly traded stocks that he owns, he basically has a huge stake in Apple. And then a lot of it is like financial related companies. So when you think about what you're getting when you buy Berkshire Hathaway, you're getting that type of exposure. And then you get obviously the big insurance piece through Geico. And then you also have the railroad and the energy piece. So it really is a truly, to some extent it doesn't seem diversified, but when you think about it in that way, it is a pretty diversified set of businesses.
Yeah, obviously, like we mentioned before, I mean, he doesn't have that many businesses to choose from, so it is impressive that he's built a pretty diversified group of high quality businesses, given what he can invest in and given what's available to him.
Did you think that when I was reading the part where he talked about all the different types of investors that can buy Berkshire Hathaway, which I'll let you talk about. But I mean, that's exactly what we talked about with Professor Cunningham on the podcast.
Yeah, and what's interesting about Buffett is, what Professor Cunningham called the high quality shareholders. I mean, that's basically what Buffett exclusively focuses on. So some companies, want any kind of shareholder they can get. They just want you to buy their stock. Buffett really, everything he does in the letter, he won't split the stock. He's not going crazy about, what earnings versus estimates in any given quarter. I mean, everything he does is based around these people that hold the stock for the long term and that hold the stock for the right reasons. And so I think that's really important because he just doesn't care about any of these short-term things. He doesn't care if the stock price goes down in the short term. He's really focused on the kind of shareholders that will stick with him throughout anything and the kind of shareholders that are really big believers in the company. And, you see that in the way sort of every aspect of how he operates the business.
Yeah, so he talked about there's 5 types of shareholders. There's the owners, which is basically like Buffett and Munger. So that's number 1. Number 2 is index funds, the Vanguards of the world. Number 3 is the active professionals. So those people maybe trying to beat the market that allocate to Berkshire Hathaway. And then number 4 is active investors, or what Professor Cunningham would call, I think, transients. And then there's 5, which is the most important shareholder to Buffett. It's these long-term individual investor shareholders. And I think he gives some examples in the letter of like this doctor group that invested with they were in the original Berkshire partnership and that got liquidated, but then their share got converted over to Berkshire Hathaway. And, these guys are still in Berkshire Hathaway, probably worth tens of millions or hundreds of millions of dollars. So those are the types of shareholders that, like you said, Buffett really wants to get on the bus. And I think the evidence is pretty strong that the turnover in the shareholder base is very low. That's something that Professor Cunningham has highlighted in his research, that the people that actually are investing with Berkshire Hathaway, they are sticking with him for a very long period of time.
Yeah, I mean, if you looked at every public company and said, what percentage of their shareholders are these high quality shareholders, I would have to think Berkshire might be number 1 on the list. He's done everything you possibly could to attract those kind of shareholders, and it seems like he's been successful. And I think that's certainly good for Berkshire long term.
So the middle of the letter, I'm not going to go through this in too much detail, but he basically is talking about all these different success stories going back to See's Candy or Clayton Homes or National Indemnity or these or Pilot Travel Centers. He basically is giving you some historical perspective around how these companies were formed and how they have survived and been successful over time. I mean, another one is the Nebraska Furniture Mart, and he talks about how it was a mother and son, but the son went off to World War II, and then when the son came back, basically the company had like, I don't know, had like $50 in its checking account, and now it barely survived, but they were able to survive, and now it's like one of the largest furniture companies in the country. And, Berkshire Hathaway basically owns it. So anyways, those are just, those are cool stories to, I think, read about because he brings so much historical sort of perspective, using these companies as examples. But his overall point with all of that is, never bet against America. He's a believer that American capitalism and the ability to succeed and, create success stories in this country it's probably the best in the world. So that's a message I think he's continued to drive home for basically decades now is, don't bet against America when it comes to our ability and the companies in this country to thrive and be successful.
Yeah, and there's so much noise out there right now in the market. I mean, you've got things with GameStop and options dealers and people buying, tons of call options. And, that's an important message to probably keep in mind with all of this is we all get wrapped up in all this craziness that's going on day to day. But, the odds are, 20 years from now, we're not going to be too concerned about that. And so I think it's good he's sort of bringing it back to an overall message everybody can sort of understand and believe in versus all this noise we probably get caught up in on a day-to-day basis.
Yeah, that's one thing that Jason Zweig has talked about with Buffett and Munger is their message is consistent. Like if you read this letter and then you go back 20 years from now and read, another letter, listen to maybe an interview they gave, a lot of the messaging has been consistent, and that's important. And I think that consistency is plays back into, the types of shareholders they get, which is, their message hasn't changed. They haven't toggled. They've stuck to their guns. They've stuck to their investment philosophy. Now, with that being said, Buffett has also maintained some flexibility to the point where he, wasn't buying technology stocks, but then he pivoted and bought Apple and sort of opened his eyes maybe to the value of intangible assets or assets that, you can't really see on the balance sheet. So, but I don't think that's, I think you can evolve as an investor like he has shown the ability to do, but still maintain sort of that important, consistent message about what he believes it takes to be successful in investing and some of the stuff we've talked about. So,
and it's a lot of people don't want to hear it right now. I mean, if you looked at the most traded stocks on Robinhood, I bet Berkshire is not anywhere to be found on there. So a lot of these people that are coming into the market now don't want to necessarily invest in a company with that type of message, but it is the right message long term. I mean, trying to do this day trading and option buying, I mean, that typically ends badly in the long term, and so that is the right message for people to follow.
One other just quick little interesting fact I thought, and Buffett wrote this, he didn't even know this about his own company, but basically Berkshire Hathaway has the highest amount of assets on its balance sheet compared to any other company. So Berkshire has 154 billion in depreciated fixed assets on its balance sheet compared to AT&T at 127 billion. And one of the things he sort of says in the letter is, it's better to find companies and invest in companies that don't need a high amount of fixed assets to maintain or generate profits and try to maintain high margins. But there can be some good investments like Burlington Northern that, these are capital intensive businesses. They require, big investments back into infrastructure, but they also, mint nice profitability. So he sort of is just highlighting how, I guess, big Berkshire is in terms of its asset base, but then sort of uses that as a way to talk about, it's good to find asset, maybe lighter businesses that have higher margins, but you can find companies like Burlington Northern that do have a lot of capital, but generate a lot of profits as well. Was there anything, just before we wrap up, was there anything you wanted to highlight that he didn't discuss or anything that jumped out at you?
Well, no, we talked about it before. I mean, he definitely didn't talk about as much about what's going on with the market right now. He didn't talk about GameStop or any of those things in the news. And, that's probably a good thing. I mean, again, his message is always a long-term message. And, a lot of that is noise. And I don't know what commentary he would have provided around that anyway. So, but it was a little surprising. I mean, he didn't talk much about unless I missed part of it, he didn't talk much about what's going on in the market right now at all. He really focused on more of a long-term message.
Yeah, no, I agree. I thought there might be, because the Buffett indicator is like an all-time high, I thought there might be, he has in other shareholder letters talked about not necessarily maybe valuations, although like they can't find any opportunities because things look expensive or whatever. So, you didn't get a lot of that or any of that in this letter. I was kind of thinking that, maybe he might signal, and even though Buffett is anti-dividend, I get it because he doesn't like double taxation, so companies have to pay tax on the profit, and then shareholders have to pay. But some people have been advocating because they hold so much cash. But I guess he's buying back stock, so it's a more efficient way to put that capital to work. But yeah, you didn't hear about Bitcoin, you didn't hear about SPACs, you really didn't hear about Buffett's replacement, and you also didn't hear about Wessler and Ted Wessler and Todd Combs, which I kind of thought was a little interesting, although I think Todd Combs now runs Geico, so he might be a little bit less involved in the investment side of it. But those things just, I don't know, those were interesting things that weren't mentioned. So anyway, so yeah, just in conclusion, I think, the reason we're talking about this is because Buffett's letter is full of wisdom. I think they offer a combination of like history, long-term investing, wisdom and concepts. You get some accounting in there. You obviously get the discussion around stocks and companies and things like retained earnings. And just, I think like they say, if you basically read a couple things in the markets, Warren Buffett's letters, Howard Marks memos, and maybe some Ray Dalio stuff, you're going to get a significant amount of what you need to be a, successful, educated investor. And I would certainly recommend people start with Buffett's letters because they are excellent and they're always fun to read and insightful.
Yeah, and hopefully we'll get to a point here where tons of people will go down to Omaha again, and go to the annual meeting and get that whole event going, because that is definitely something I think everybody's missed.
For sure. All right, guys, thank you very much for listening. We'll see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.